Hey everyone, this is Robert Keens with goldsilverpros.com. It is Tuesday, September 22nd, 2020. And I wanted to do a video on the smash that's going on in both the gold and silver right now and take a look at the volumes in the futures market, showing us what exactly is going on. And then I also wanted to do a little bit of a fundamentals lesson on the dollar versus gold. I've been seeing a lot of headlines lately in the mainstream financial press about how a gold is moving lower due to the strength of the dollar. And I really wanted to dispel the notion that the gold and dollar always move inversely. It really doesn't happen. We're going to show you some charts as to why that is the case. And I'll explain why I think that's the case. But that's the common narrative being used right now. And I think it's a cover for what's actually going on in the futures. And I wanted to get a little bit more into detail about that if you're not familiar. So we'll go ahead and start the screen share here. And you can see this is the gold chart, and I have it basically a 3-month chart, as you can see. And the negative trade volume really started, I believe, on the 19th. And of course, coming back from the weekend with very heavy negative volumes here in the December contract. And that's why the price is falling. So I'm going to show you that. Look at the amount of volume being traded in December right now, 386,000 contracts with a total open interest of 426,058 open. That's a lot of volume, and you can see it here in the chart, 411,622 on September 21st. So if we just look at the volume number is printed here and multiply that by the contract size in gold, it's 386,667 times 100 ounces of gold. Right now trading 39 million ounces of gold, and that's mostly paper. Well, obviously it's paper because you can't take delivery in December yet until we get closer to December. The $38 million for the paper gold being traded on the market, and that's what's smashing the price down. That's essentially why you have gold falling. Now gold has fallen. I think I saw it a few minutes ago at about $18.99. So it's challenging this $1,900 mark. We're going to zoom out on the chart. I'm going to show you why that's significant. We'll go back to the previous gold bull. Right at $1,900 is the previous high in 2011. We drew this this resistance line, which came a support line when gold popped up over 2050 recently. And it's kind of worked its way back down to that line. It's testing support here. This was a resistance line up until the June-July timeframe, and now it's become a support line. So it's testing support. I don't see it falling through support right now, but it could. And if it does, we'll probably go into that cup and handle formation where you see gold fall down to somewhere in the $1,700 to $1,800 range. Of course, that would be a confirming move that we're probably in a bigger gold market, bull market, that we'll see gain strength probably as December starts to roll around and we see how much physical is delivered on the COMEX. But it's pretty obvious that there's a big smash going on with all the volume that we're seeing, and just the negative positions on the chart. We'll go back to the 3-month chart and show you that again. Just the negative positions that came in beginning of this week trying to smash the gold price down from about the 1960 range. So that's essentially what's going on. It's just a paper trade. If you're in gold and silver, especially the physical metals or even the mining stocks, I wouldn't worry too much about it. We're going to have a lot going on leading up to December. I wouldn't let it shake you too much. We're going to have a lot of news leading into December. You've got the election coming up. You've got worries about the economy, a lot of stuff to keep the gold price pretty frothy. And then, of course, in December, if there's any amount of deliveries, I think we're going to see a much stronger gold price. Wanted to look at silver, basically the same thing almost on the same day. And again, when you look at this stuff all the time, you start to see these patterns. You just see the smashes happen on the same day or within 24 hours of each other. Look at this negative volume in silver. It didn't even take that much volume to smash the price down. Now it's also testing this support line, the 2450, which I drew, and I'll show you how we got that line. It basically was a key support line I talked about a month ago, where silver could retrace down to this line because it was a key support and resistance line actually from the previous bull market. But I think an even stronger one is a $22 and really strong is a $20. So you could see silver start to fall down a little bit more if they keep paper smashing it. Of course, here's the paper smash. You had 185,000 volume of contracts basically trading on the 21st, which is ridiculous. Let's see how much silver that is. Now, silver has traded 5,000 ounces of contract. So we're going to look at 180,888 contracts times 5,000. So you're looking at almost a billion ounces trading in the December contract right now. A billion ounces of silver. That's of course, we don't produce that much silver in a 2 to 3 month time span, which is where people are trading that December contract from September to December. So why is all that paper coming in the market? I think it's basically a lot of short positions coming in, smashing the price down. And of course, that's not going to last forever, because if we see more deliveries, that'll tend to affect the price, especially if we're going to have any sort of shortages going on the COMEX. Let's look at the metal deliveries report. So we can see very strong metal deliveries and COMEX for both gold and silver for this month. I think we're up to 4,409 gold contract deliveries. So multiply that by 100 and you have 400 something thousand ounces gold, which is very healthy. We're going to come down here to silver futures, and you had 10,708. So that's not quite as high as we saw in July. I want to say we had 17,000 or so deliveries in July. We've had 10,000 so far, but that's a very strong number for a month in which you didn't have, you know, a lot of open interest or volume. So basically what people are doing is they're coming in. Again, you can see the deliveries are higher than the open interest change. That means people are coming in this month and they're taking delivery of the metals on very short dated contracts in both silver and gold. You see it in both silver and gold. I think gold, we remember we had 3,070 contracts, September contracts roll over from August, and we've had 4,409 deliveries. So we're about 1,300 contracts up from the open interest we had at the beginning of the month. It basically means at least 1,300 and probably a lot more contracts have been opened during September, during the trading month, and people are standing for delivery. Again, indicates that some people are panicked about the amount of metal in the free market, and they're thinking potentially that there's going to be some sort of shortage. So they're coming in very heavy on this month and taking delivery, while at the same time, the paper is smashing, as you can see with all of this paper contract here in both silver and gold leading off the week. So paper smash, cheaper metal. I would, you know, if you're a stacker like I am, I would just buy more of the physical. That's just a cheaper price for you to get it at, and I wouldn't worry too much about it. Commitment of Traders, the new one came out, dated through September 15, 2020, and I wanted to look at that really quickly to see who's taking what positions in the futures market. We can see that the producer merchants have gone net short about 3,500 contracts in silver. So minus 857 long, plus 2713 short. So a lot of the shorting is actually coming from producer merchant category. We had 1629 reduction in long and 1689 increasing in short from the bullion bank. So they're about 3,300 net short. So about 3,500 net short producer merchant, 3,300 net short. The swap dealers, the managed money went extremely long. They dropped 145 shorts and went 32.96 long. The managed money is doing this both in gold and silver. You'll see on the gold here in a minute when I show you. And then the other reportables are about net even, maybe, what is that, about 50 contracts. I'm sorry, about 1,400 contracts net long, because they dropped 739 short and 680. So a lot of longs, managed money and other reportables, and a lot of shorts and producer merchant swap dealers in silver. It's just people, you know, taking their positions for September. Of course, the swap dealers do it to keep the price down. We know that. And I think the producer merchants do it because they're afraid of the price continuing to fall, and they're trying to protect their investment. So in gold, we're going to look at the Commitment Traders report. Again, open interest, 578,925, which is just a massive amount. Again, it's all paper. I mean, you can see it in the numbers. It's all paper trading there. The producer merchants were kind of funny. There are 1,900 new longs open, 2,600 new short, for a net of about 700 or so short. Really short, the swap dealers. They did open some longs 1243, but they went short 46.25. Of course, this is how you get the metal. You open more shorts to keep the price down, and less longs to actually take delivery of that metal, so you get the metal at a cheaper price. You see this on the swap dealers reporting all the time in both gold and silver. If we go back up here to silver, you see a little bit different. They're actually going short silver, but in gold, this is how they do it. They go net short and basically take the metal cheaply off the market. Now, the managed money here has gone extremely long, although net, it's only about 7,000 long contracts. Just a lot of trading in managed money. A lot of people thinking gold price is going to fall, so about 4,200 short contracts in gold. Over 11,000 longs, though, net managed money went long about 7,000 contracts. That's a lot. So they're betting on the price of gold going up. Of course, other reportables, basically net short, opening 2,598 minus the 296, about 2,200 contracts net short. So overall, you just see a lot of trading across the board. Everybody positioning for what they think is going to happen in each of the markets. And that's why you see so much volume here on this Monday in both gold and silver. People really increasing their positions. Of course, the COT data I just showed you is a week old. So this data I'm showing you is not actually just yesterday, this past Monday's data. It was leading up to September 15th, but you can see the buildup already coming in these numbers. And of course, next week, whenever we get the COT for this week's data, we'll show it to you, and then we'll try to make some comparisons there. So again, just big paper smash going on. I wouldn't worry about it too much. Gold, sorry, this is a silver chart. It's challenging the 2450 line. I wouldn't worry too much unless it goes and stays below 2450 and gets down to 2022. Then you just pick up your silver cheaper and wait for December to see what happens with deliveries. On the gold chart, we've retraced. Let's go back to the longer chart. We've retraced a little bit, but nothing that we wouldn't have expected during a healthy little correction. It's still trading near its all-time highs back from 2011. It hasn't done the cup and handle yet. If it falls down the 1700 range, I would anticipate that means a larger bull leg is coming up, ending this year in December and then into 2021. Okay, so that's basically the market report for today. Now I wanted to take a look at, do gold and the US dollar move in opposite directions all the time? And when people are saying that the dollar has weakened or a dollar has strengthened, they're not talking about the purchasing power of the dollar. I just wanted to be clear there. What they're talking about is a dollar against a basket of other currencies. The USD is the dollar against the euro, the pound, all these other currencies in that basket. So it means the dollar is appreciating towards those other currencies or depreciating. It has nothing to do with how much general inflation is in the economy or how dollar relates to gold specifically. So when you see an article on CNBC or Bloomberg or whatever saying, oh, the dollar's gotten stronger, gold has fallen, sometimes that relationship holds true, but most of the time it doesn't, because they're not directly related. And I'll show you why. If you look at this chart, dating back to 2000, we've got gold as the gold line here and dollar as the black line. You saw a very sharp fall in the price of the dollar, but only a very gradual rise in the price of gold. I mean, you're talking the dollar falling massively on this scale and gold rising only a little bit. And then you see gold rise when it falls, but this fall in the dollar is more pronounced than the rise in the gold here. And again, the gold's rising overall, but the dollar here starts to range trade. So you see, this is basically a range trade in the dollar. It's falling, moving up and down, in this area, but gold continues to rise. So you could say this is a lag from this massive fall in the dollar, this rise in gold, but that's quite a bit of time lag, because from 01 to 011, you saw this move in gold, but basically from 02 to about 05 was the fall in the dollar. So about a 3-year fall in the dollar leading up to what, a 10-year rise in the price of gold. You can see right now how those timeframes don't match up. So gold and dollar don't always move in opposite directions. In fact, you can see gold falling pretty precipitously here down from 1900 down to about the $1,200 range. And the dollar is basically trading sideways to all of a sudden it goes a straight move up. So again, straight move up, gold is range trading here. Then the dollar and gold are both range trading together and not necessarily in opposite directions. You see gold and the dollar basically the same here. You do see a difference here, although the gold is range trading here, the dollar is falling. So again, not a match. And then as you see, as gold has risen, the dollar rose along with it for the first, I would say, about 6 or 8 months of that. And then the dollar finally fell as gold started to come up. And now gold has come down and the dollar's moved up slightly, but they're not the same move. So this is not a mirror image. And it means that the gold and the dollar don't always move in opposite directions. Something else I want to point out, Mish who's basically covered the economy for a long time has great analysis. And he actually charted this back to 1970. So using Fred data, but here you can see gold and the dollar don't move in exactly opposite directions. You can see here a long period of random moves here. You can see where one is moving a little bit and the other is moving sharply. You can see where that's a relatively modest little bull formation. This is a very big spike formation. And then you can see where big spike formation here, a little bit of range trading, just as I showed you on my chart from 2000. This is the part that I showed you on my chart, but basically the same thing dating back to 1970. So again, the dollar and gold don't always move in opposite directions. Sometimes one moves more sharply than the other. Sometimes they range trade together. And so when people say the dollar's strengthening and gold's weakening, it's not a strong argument. And I've never followed that. And that's because the US dollar index, when people are saying the dollar is weakening, they're talking about against other currencies, not against purchasing power, which is measured in gold. Gold is your measure of purchasing power over time. The USD index is the measure of one currency against another, not necessarily that currency against like a basket of goods or inflation or gold itself, which is helping to measure purchasing power over time. So, I just don't buy into that gold versus dollar argument. I think we've got plenty of data here to show from Mish and then from my own analysis why that's the case. And, I would say don't listen to mainstream news on that. It's really not a fact. It's not a relationship that has proven to be overall conclusive. So I just kind of don't buy into it. For short periods of time, sure. A lot of times they'll trade opposite. And those are short-term market reactions, because I think a lot of people think that, oh, gold's going up, the dollar must be going down, or the dollar's going up, we have to, hammer the price of gold. But I think it's actually a cover. I think when you see, let's go back to the screen share, when you see all of this paper shorting come in, let's go back to the short-term chart. You see this paper shorting come in, this massive volume here that we see here that's bringing the price down, all this massive paper trading that has nothing to do with the physical. And then you see an article saying, oh, the dollar's going up, and then really the smashing gold's in the futures market. It's not in the natural movement of gold because the trends don't line up. So I think those stories you see in the mainstream press are a little bit of cover. A lot of times when you're looking at the mainstream press, they'll give you these weird excuses for why gold is up or down. Oh, the Fed said, Powell said something, and so gold had a sharp move today. I think it has more to do with futures action. I do think long-term traders do trade the futures market based upon economic data, their view of the dollar, their view of the Federal Reserve and how much money they're printing, or I'm sorry, how much debt they're buying, or whatever the case may be, how loose monetary policy is. But those are really covers. The long term, what really moves the price of gold is basically how much fiat's been printed, how much purchasing power is declining, and people's confidence in the economic system. So a lot of those short term sort of stories on the dollar, gold, or the Fed and gold and all of those things, I don't see strong correlations there. I do think traders take into account, but over the long term, they really don't hold up. What really matters to gold is real negative interest rates, which I talked about several weeks ago. When you get lower and lower rates in the economy and inflation rises, and then you end up having a negative real interest rate, meaning the yield you get on like a bond minus the inflation rate's a negative number, that's when you see gold start to rise. And we did a video showing 700 years of falling interest rates and the rise of gold. That is a trend that has stayed true for a very long period of time, centuries. But this dollar gold, or what the Fed says gold, these are little blips on the radar that traders will use maybe to take a position, but it doesn't drive the overall price of gold. So I kind of wanted to dispel that notion. I think they're trying to cover up for what's actually going on in the paper trade. So you don't look at the COMEX and you don't look at those futures. And that's why the general financial media is kind of putting those excuses out there. And if you listen to it on a daily basis and you're not looking at the charts like we're doing and seeing what's happening in the futures market, you may actually believe that. I actually kind of believe that the first few years I was investing in gold and looking at gold until I started taking a longer term view of the data and then looking at the futures market. And then I started figuring out what's really driving the price. And I don't think it's as much that news. It's a consideration, but that's not really what's driving the pricing of gold and silver. So I just want to make that point. I hope you guys found value in this video. I'm going to do a really good segment on Thursday about something I haven't talked about on the COMEX, which I think is also driving the price of gold and silver down from their previous high, or gold from its previous high about in the 2050 range, and then silver when it popped up to about 29, that I haven't shown you before. So stay tuned to Thursday. It's going to be a very informative video. We're going to have new research for you. I think you guys will get a lot out of it, and we'll definitely enjoy that one. Till next time, this is Robert on goldsilverpros.com.